to have this on Facebook, wanted to have it on YouTube, but YouTube not working the way that I had hoped. So Jason has been very patient, especially Mr. Parker. You might be a little busy these couple days.
Yeah, pretty darn busy, that's for sure.
A friend of mine who was here in the basement at game night last night said these, and he's a certified financial planner like you are, said these are the times when you earn your money.
Amen, brother.
This is it. So
this is what we were designed to do. This is why I'm so well, this is scary times, because this is real people's money, real people's retirement, real people's security. But it really underscores the power of planning, so that when these times hit, the people are prepared, and they know that they've got a good plan in place. Now, I know not everybody has that, so we got to talk about what they can do today as well. But yeah, I feel really good about the way that we were prepared going into this.
In just a little bit, guys, we're going to take a look at the retirement budget calculator that and if you haven't heard, you can go back to last Friday's episode when Jason was on talking about that. Originally, that's what we wanted to talk about today. Obviously, we've got some bigger stuff going on, Jason. So, yesterday was a super weird day. I think super weird is not even the right expression, but
volatile, man. This is, I started Parker Financial, an independent fee-based registered investment advisory firm, in 2007. Think about the timing of that, right before the financial crisis. I mean, our firm was born in the darkness. We were born in the fire. We were born in the belly of one of the worst financial meltdowns in the history of the market. So, a lot of the things that I teach people today are based on the fact that I already walked life with real people through those times, and just trying to put together a structure from a planning standpoint to make sure that people weren't going to be hurt like that again. So all of the work that I've been doing the last couple of years, you can see how that event affected us and all of the strategies that we've built for folks. But now we get to walk life and we get to do it again. So we're in a position where now the market is some of the most volatile. Yesterday was the second biggest drawdown since 1987. And we're walking life with real people through some really hard times right now. And it's like a quadruple whammy, right? We've got the coronavirus. I'm out here in Seattle. I know what it's like to be fearful of the people you care about getting sick, especially a lot of the people we serve are retired or about to retire. So they're really at risk of this thing. So there, you've got the fear associated with your health. Second, you've got the stock market volatility. So not only do people have to worry about their health, that now they're also worrying about their money and whether or not they're going to be okay. Are they going to get laid off? Have they saved enough? Do they have that emergency fund established? All the things that we teach all the time. Now it's coming into play. I mean, did you have a plan going into it? The third triple whammy was Russia and Saudi Arabia deciding, to be a bit opportunistic, and to, at a time when there's this great fear and this great panic, to just juice it a little bit to try to squeeze out the shale oil producers in the United States. And that should make everybody a little bit angry, because that was not accidental. That was not, that was very
timed.
Yeah, somebody made a decision. And then, of course, you turn on the headlines last night. You've got some missiles being thrown at some targets in Iraq that have to do with Iran, and so you've got this quadruple whammy. You've got and then we've got the presidential election on top of it all. And so there's never been a time in the last 10 years where we've had to experience this much volatility at once. And Joe, one of the things I'm really concerned about is people's mental health as they're going through this, because I don't think anybody was designed to try to have to cope with all of these things at once. And so one of the things we need to be thinking about is just how do we get our thinking right as we're going through these times? Because there's that saying, how's it go to be able to keep your head when all others around you are losing theirs? I can tell you, the people that I know that are the most successful investors, they're using this as a buying opportunity. People that are young, that are still contributing to their 401k, should not be thinking about sitting this thing out. This is the time to be dollar cost averaging. Hopefully they don't need this money for a really long time. So this is a great buying opportunity. And the people that really need to be the most concerned, and hopefully they had already taken steps, were the people that are just getting ready to retire or people that have recently retired. And hopefully they've already got a really good strategy in place to deal with the volatility. So yeah, I mean, this is a real deal, man. This is, like you said, this is what advisors are in business to help people walk life through.
I want to talk to specifically, Jason, some of the things that I've seen online lately that I get, but it's not the right way to think about this stuff. And by the way, not that I nor you know what the future holds. And by the way, I think that is part of the danger, especially if you're in an online forum reading people. It's so funny how many people have opinions about what's going on, where they seem, the opinion supposes that they know what's going on. And I'll give you an example. When I see people talk about buying the dip, right? Buying the dip in the market. You've been through a big downturn in the market. I've been through 2 big downturns in the market. It could go for 2 years. I mean, and don't get me wrong, you should have a dollar cost averaging strategy, but when you're taking cash and you're picking a day and thinking that this is going to be the optimal day and we're going to make a bunch of money, crazy talk. Somebody here in our Facebook group today said that the person selling them eyeglasses was that person was telling them that they should take every dollar they have, find $10,000, put in the market today, because in the next couple of weeks it's going to go back up and they'll, Jason, make a lot of money. That is crazy. Don't buy the dip. Don't think it's going to go back up to, we have no idea. So I think it makes far more sense, Jason, to keep a long-term approach.
Well, absolutely. You know, we were in the longest bull market in the history of the market. Everybody knew that the stock market was expensive, the bonds were expensive. I mean, that has not been a secret to anybody. And we all knew that there was going to be something that brought it to an end. The problem was everybody got so comfortable with risk that it was risk on all the time. And everybody thought they were a great investor. And they thought they had the stomach for investing because they were 80, 90% stocks when they probably shouldn't have been in the first place. And so, but you're right, Joe. I mean, like I say, the foundation is you should have had 6 months of cash, 3 to 6 months of cash on hand in your emergency fund. You should have been invested. So if you were sitting in a large pile of cash, that meant you lost out on all of the returns up to this point. And then, one of the hardest things you will do in a market like this is to stick with the discipline of the strategy that you built in the good times. The reason we build a plan in the good times is when the bad times hit, we know what we're going to do. And so, for example, taking all of your cash and running the market, is that the good idea to do right now? Well, I don't know. Like you said, I don't know when the market's going to rebound. I don't know when the market's going to recover. But what I do know is that just because we're going through a financial crisis right now with a health scare and some of these other things going on in the world, I don't think we're going to be at a place where when the dust settles, that people are going to stop buying goods and services. That's not going to happen. I mean, we're not going back to living a bartering system. People shouldn't be buying gold out of fear. They shouldn't be thinking this is red dawn and moving up into the mountains. We've got some fear in the market right now. There's that saying that Warren Buffett, I think, said, when there's blood, you want to be buying when there's blood in the streets. And I'll tell you, there are some really good, if you're kind of a cherry picker from a stock position, there's some really good positions out there that look a lot better today than they did a month and a half ago.
Well, I'll tell you, and that actually, Jason, is exactly what I do like. I mean, it's a great time to raise the amount that you're saving into your 401k, right? It's a great time to do that. To raise your dollar cost averaging. So if it does go down the next 2 years, you're continually getting stuff more and more and more on sale.
Think about the last financial crisis you and I went through. Afterwards, didn't you say to yourself, man, I wish I would have had some more cash to invest during that time. I wish I wouldn't have let the fear take hold of me. So a lot of people say, Jason, I'm fully invested. I really don't have any way to do this. But if you think about rebalancing your portfolio, if you're disciplined about the rebalancing, it forces you to do the opposite of what you want to do. Rebalancing says, like in times like this, that you would be selling some of your bonds and buying more equities at a time when the bonds are creating the cushion on the downside, right? So, but that's why rebalancing is effective, because it forces you to be counterintuitive to what our emotions tell us. Our emotions tell us sell stocks, buy treasuries, but we know that eventually there's going to be a rebound. I mean, nobody can guarantee that there's going to be a rebound. Maybe we're going to be in a 15, 20-year rut as a result of this thing. I don't, history hasn't told us that that's the case, but certainly anything's possible.
I'm smiling because back in the days when Bloomberg had an actual print magazine, they had a story about rebalancing and about asset allocation in general. And you'll love this, Jason. In the story, it said that rebalancing your portfolio takes, quote, guts of steel. And the reason is when you hear somebody like you talk about rebalancing, it makes a lot of sense. Like up here, it makes a lot of sense. But when you actually go to do it, here is what it really looks like in real life. Let's say that you are half stocks and you're half bonds, like absolutely horrible asset allocation, but it's half stocks, half bonds. Lately, what you've seen is that your stock portion has shrunk to, instead of 50%, let's say it's 40% of your portfolio now. Now, what you're saying is, I'm going to rebalance to get back up to 50. So you're naturally doing, Jason, what you're talking about, buying it when it's lower, right? To fill in and get back to that 50-50. That sounds good. But when I used to meet with people, this is what my client would hear. They'd say, okay, Joe, what are we going to do about this strategy? How are we going to do this? And I'm like, well, you know what? We're not going to react. We're going to stick with our investment policy statement, but our investment policy says that we are going to rebalance the portfolio. So here's what we're going to do. We're going to take some money. See this fund right here, which is the bond fund that is held up nicely. They go, oh yeah, the good one, the good one. I call it the bond fund. They would call it the good one, right? The good one. Okay. What I want to do is sell some of that so that we get it back to 50%. And my client looks at me and goes, are you crazy? Why are we selling some of the good one? This is the one that's been doing the best lately. Why are we going to do that? Well, you've been a good advisor, Joe. Tell me what you want to do with that money. And I point to the stock one. Like, no, you don't want to buy more of the bad one. Why the hell do you want to buy more of the bad one? Like, what are you talking? Are you crazy? Who wants to do that? So emotionally, it's very difficult to clear that hurdle. Rebalancing
forces you to be counterintuitive. It forces you to sell high and buy low. Now, Michael Kitces, he has this little image that he's been sharing, and he says, when you're diversified, you're always apologizing. You're always apologizing to diversified investors, because when the stocks are going up and the bonds are going down, then you're apologizing for the fact that you've got the bond portion in the portfolio because it's just not performing as well as it should be. And then vice versa, when all heck breaks loose and the bonds are doing well and the stocks are doing poorly, then you're apologizing for the stock portion and the bond portion. So you're just, diversification puts you in a position where you're always apologizing. And that's in
1999, I got fired by a client because his portfolio only had a 12-month return of 43%. Because his buddies were, remember, that was the big tech run up. People were up 100, 140%. Right. And I got fired because we were in the mid 40s. Like that was bad. And you know why? Because I had to apologize for diversification because we were keeping our wits about us. Yeah. It was crazy.
Yeah. What I know is that people that sell, they go to cash. It seems like the most logical thing in the world to do because the fear is so high. The challenge that they're going to have is knowing when to get back in. And what we know is that most people get that timing wrong completely. So, and unfortunately, the people that are going to miss out are the people that I mean, if you're young and you're still working and you've got a good job, and you're just going to miss out on all the buying opportunities. So, I mean, I hate to sound like your typical advisor, but the reason that people hire us is to stop them from hurting themselves, right? It's to stop them from making emotional decisions. We make plans in the good times so that when the bad times hit, we stick with the plans. And you know, I have to tell you, and we're going to get into what planning looks like here in a minute and why it's so powerful and why it can really help people have more peace of mind. But like I say, there's a lot to be worried about right now. And we want to settle people's minds down and get them thinking about, you know, how are we going to respond to this? Instead of reacting, how are we going to respond? And if, you know, we're one of the 98%, 97, 96, 98% of people that survive the coronavirus, and we're looking back on this time, who did we become? You know, what were we as a society? What were we as a people? And we're all going to have to answer that question. And so I'm encouraging people to step up. This is the time to drive a little slower, have a smile on your face in the grocery store when everybody else is, got this look of doom and despair, and to reach out and help our neighbors. I mean, that's what we need to be doing when times like this hit. So
I make sure I keep a big smile on my face while I'm stealing the toilet paper from the last toilet paper roll, so you can't get it.
It's a real deal, man. My wife sent me to Costco when this whole thing started, and I didn't know there was a run on toilet paper. I couldn't believe they didn't have any toilet papers.
When I was at Kroger 2 days ago, huge lines, by the way, at Kroger, and usually the Kroger down the street for me is not very full, but the only toilet paper that was left was the good stuff, the like really expensive ones, which I'm a man of a certain age. I deserve the good stuff anyway, Jason. So
it's good. That one of the things about your show that's so good, Joe, is that it's very lighthearted and you have this ability to have fun no matter the circumstances. But the reality is this is scary times.
Yes.
People are getting hurt, people are dying, and we want to be respectful of that. But at the same time, we don't want to blow up our financial life because we making irrational decisions, and people and when you're making emotional decisions are probably not the best decisions. So
it is incredible that I was talking to, my co-host OG yesterday, talking about how he was spending the entire day reminding people that doing nothing was the best move. Sticking with your plan and doing absolutely nothing. It's sad because I see people in forums, because, for what I do all day, I spend a lot of my time in internet forums. And I saw somebody earlier today in a forum who was saying, hey, do you think it's a good idea that I back down my 401k contribution and instead pay off my debt with that money, right? Because the debt's at a fixed interest rate. So he's like, hey, instead of losing money, well, no, that's horrible. It's absolutely, you should be doing the opposite. But it's funny that, Jason, what you and I are talking about is feel the emotion and remind yourself that usually the opposite of what your emotion is probably the right move. Yeah.
Well, Warren Buffett, he was interviewed the other day. He's considered the greatest investor of all time. And that he's been sitting on a big pile of cash. But when asked if he was selling any stocks, he said, no, he's not selling any stocks. He said, stocks look a little bit better today than they did a couple months ago. And so if we can learn something from the greatest investor of all times, he says, buy when there's blood in the streets. And so hardest thing you'll ever do is to work against what your brain is telling you, because your brain says run for safety. Your brain says that you got to get out of here while you can. You got to stop the bleeding. And we just know that that's how people get hurt, and that's how people miss out on most of the returns of the market over a long period of time. So at the same time, they should have had a good emergency fund going into this. They should have had a good plan going into this. And now people are starting to experience the consequences of not taking being responsible up front, not doing the right thing in the good times. And so that's the people that are probably hurting the most.
I want to transition over to the calculator on that note, because this planning that you're talking about, I think is huge for people. But before we get there, Jennifer, I just wanted to say hi to some of our friends hanging out with us. So she's going to sell rolls of toilet paper to make up her money. And Melissa had the same thing that I had, which was line wrapped around the store it's incredible. Some of the long lines at stores. So
I'm just curious to know from the community that's here, though, Joe. I mean, because really, this is going to bring out the best and the worst in people, and so I want to know, if we're going to respond with the best, what does that look like from the people that are here today?
If we're only selling the toilet paper for $200.
I know somebody that had these, the masks. And they thought it would be a good idea to put those on sale on eBay or something and jack up the price. And they quickly got an email from eBay saying, hey, we don't allow this type of, people to take advantage of.
Yeah.
And they shut that down pretty quickly. So
almost like surge pricing,
Yeah.
Kind of thing. All right. The main reason that we were going to be here. Oh, and I did want to say one more thing, Jason, because we did a story about this on Money with Friends this morning. while there are similarities to the last two downturns that I've been through when I was a financial advisor, there's also a lot of differences. And one key difference here is that, let's take the 2007, 2008 thing, Jason, specifically. That was a cleansing of some things that were bad in the system, specifically mortgages being sold in ways and to people that probably shouldn't have had them. So there was this cleansing of a lot of debt happening. That is not what's happening here. I mean, this is around a pandemic. So because of that, we're going to see a lot of differences in this market. And frankly, that makes it even scarier in some ways for people thinking, I want to get out, because it's around events. You know as well as anybody, you can't predict events. You can't predict news that's going to happen tomorrow. So, I mean, who would have known that every sports league in the United States would shut down yesterday?
It's having a real impact on the world. It's hurting people. It's going to hurt the economy in the short term. There's no question about any of that. And so the question is, how are we going to respond to it? What's the right thing to do?
Here's Eric. You talk about being, how are we going to be a better person, better community member? Using a phone tree to reach out to older members, encouraging people to reach out to neighbors. There you go, Jason.
Yeah.
There it is.
One of the big differences too, Joe, about this crisis is during the financial crisis, people didn't understand what was going on. All of a sudden, banks just started shutting down. Remember, I walked life with real people during that time. I remember the scare of the money market breaking the buck. You know, it's like, man, you tell me our money's not safe in a money market account right now, and all of the extraordinary measures that the Federal Reserve took during that time, and helicopter Ben Bernanke, you know, saying I'd throw bags of money out of a helicopter if that's what's going to need to get there. But what happened there was people still had resources, and they still had a sense of their physical well-being, so they could still go on vacation and just say, well, I'm just going to go to Maui and sit this thing out and spend a couple of weeks, be with my family. And no, I don't understand what's going on. But now people are feeling like they can't do that. They're feeling like they're confined to their space. And here's, you know, my faith is important to me. And this, I don't want to offend anybody out there that doesn't believe what I believe. But I believe that that one of the ways that the enemy works is by trying to isolate people, try to get them alone, to make them feel like they're alone in this entire thing. And so now more than ever, there's just an incredible opportunity to create community, to come together. And so maybe that's through things like this, where people can stay safe, but they can still be plugged into community. And they have level-headed people that are, this isn't the first time they've been through some kind of bad event. And remember, Joe, just a couple of months ago, I remember there's so much worry because we had impeachments going on. We had a presidential election. We had conflict with trade wars with China. I mean, the headlines always give us something to worry about. But this is different because it's affecting people's health, and that's a scary thing. And again, I'm out here in Seattle, so you know, I see schools being closed, and I see people that aren't well, and I've talked to doctors, and you know, I get it. It is, I mean, it just is. My mother-in-law is in an assisted living facility. I mean, we're doing this thing together, and we're going to get through it together. But the enemy likes to get people isolated, make them feel alone, make them feel like they're the only ones, and that's typical, and that's what we need to fight against.
Need community. Dan says Mark Cuban wants to pay his hourly workers and asking them to volunteer. You're seeing some good stories in the news. Hey, do you want to get your screen ready? And let's talk about this. So for people that didn't hear last week, and the reason we originally, Jason and I had scheduled this before all this stuff happened, was that Jason and his team have built a fantastic calculator. This is my favorite consumer facing calculator, which is why we became an affiliate of this program. What I really like about it, especially on my end, is the ability to tweak some of the assumptions, and also to because you can see milestones along the way that you're trying to hit, and I really like that. So I'm going to show this in the screen, Jason. Everybody will be able to see you and the screen, but you're not going to be able to see everybody.
Okay.
So
Can you see my screen okay now?
yep. And what I'd love to do, guys, would be to put this on the whole screen. Unfortunately, Be Live with the platform we use does not allow that. So, well, Jason, I tried this earlier. If I try to get Jason and I off the screen so you can see the full screen here, you'll to enlarge that. That would be better. But unfortunately, you won't be able to hear me or Jason if we do that. But you can see here, this is, what are we looking at here, Jason? I see a menu.
Yeah, so I thought what we could do, Joe, is I could just give kind of everybody a quick overview of what the retirement budget calculator is, all of the nuances, and then kind of walk you through a case that I built to show you how it works. Does that sound good?
Yeah, sounds great.
Okay, so you'll notice as we look at the retirement budget calculator, we've got these different tabs across the top of the screen. And so the budget data entry, and one of the things I want to say is, retirement is all about cash flow. It's all about making sure your income matches your expenses. And if ever there were a time, if you're experiencing a lot of concern, one really great thing to do is really get a hold of your spending, really learn to tell your money where to go. And so I'll teach you how the retirement budget calculator can do that. But what we have here, and this is how the calculator started. I just wanted to really be granular, giving people the ability to enter income, deductions, taxes, and then under housing, you can see we kind of pre-populated a lot of expenses that a lot of people have to get them thinking about their expenses. But it's completely customizable because you can add additional rows if you need them, or you can delete rows as necessary. So you can really make it unique to you. So that was the first thing, just helping people understand all of their expenses and doing it in a way where you're not having to give up your privacy. And from the standpoint, a lot of the online calculators today, they want to connect to your bank account. They want to own all of this data about you. And so we intentionally designed this where you could enter information in. And I encourage people, as you enter information in, keep it somewhat private. We like to think everything's secure, and this is built on a secure platform, but when the IRS is getting hacked and the federal government's getting hacked and the CIA is getting hacked, it's just good, I think, if you're going to use a tool like this, to not, especially don't put any account numbers or anything like that. And so
I want to ask you a couple of questions. Well, unless you're going to dive into those again individually a little bit.
Yeah, I'm just going to give a quick overview and then we'll come back and dive into it a little bit.
Sure.
More. And then we've got assets and liabilities. So we've got a spot here. There's three important numbers you have to understand. How much do you spend? How much have you saved? And then how long are you going to live? And so the retirement budget calculator helps do all of those things. So this is a spot where you can put in information about investments that you have, real estate that you have, and then, of course, any liabilities that you have. This last one feels a little bit morbid, but it's just so that you can put in your gender and your birth date, and then it's going to tell you, based on the Social Security mortality tables, how long you may have to live, and I'll get into this in more detail. And then it gives you a breakdown of all of your income and your expenses, so what your current budget is. Helps you break down your expenses by category so you understand where your money's going, helps you identify what's essential versus discretionary. It gives you a calendar view of your spending, and then it shows you your net worth all kind of in a snapshot here. The monthly details is so that you can really dig in on a month-by-month basis, and I'll show you how I use this in a minute. The net worth is just a report that shows you, what your net worth is. The future view is what a lot of people are excited about, and I'll show you how this works. And then the buckets tab helps people understand how to diversify their money across time. So with that, what I'd like to do, now that we've looked at each tab, is kind of start at the end and then walk you through a hypothetical scenario that I've created for you. Can you still see my screen okay?
Gotcha.
Okay, so you notice I'm on the buckets tab right now?
Yeah.
Okay, I'm going to start on the budget data entry. So you notice these folks, they have income of $7,500 a month, deductions, so they're contributing $750 a month to their 401k, $900 a month in taxes. Their budget requires $6,432, and so that says they have a shortfall of $582. And I'm going to come and look at all this in just a second with you. Then we look at their assets. So they have 1.5 million in assets, $130,000 in liabilities, gives them a net worth of 1.3 million. So you can just see, I've just got a real simple scenario here. Under the time tab, he was born in 1954. She was born, let's get her closer. let's say 1956. So you can see he's 66, she's 63. The average U.S. Life expectancy for him would be 83 or 85 for her. He's been alive for 24,088 days. And if he lives to life expectancy, he'll live 6,225 more days. And she's been alive for 23,000 days or 8,010 days. And there's this verse.
That way of looking at it always freaks me out.
I know, but there's this verse that I love that really speaks to this. It says, teach us to number our days that we may gain a heart of wisdom. This really is our most valuable asset, And so we want people to live with a sense of urgency. If they're in a position where they've saved enough and they can retire, it's important to know that we don't have forever. And even if you do have till age 83, all those years may not be healthy, thriving years. And so there's too many people that miss out on the best life they have because they're always thinking about the future and they're not living in the moment. And it's a balancing act. I mean, that's why planning is so valuable.
Yeah.
Okay, then we have our quick view. So you can see I've got some data filled in here. Now, under essential and discretionary, you can see it. You can kind of drill down and see, okay, my essential expenses are $4,594, but I've got discretionary expenses here of $1,800 a month. So if I had to cut back on something because the world's not performing the way that I would like it to, I kind of know where I'm going to chop first. And then we can see a calendar view of expenses because there's an ebb and flow to how this works. You'll notice in March, we've got a big expense because these folks want to take they want to travel every month and retire every March in retirement and spend a big chunk of money. So you can just see that there's a sequence of spending risk, just like there's a sequence of return risk. And then you can see the liquid assets available. On the monthly details report, so this is the report that I use for personally budgeting on a monthly basis. And I created what I call a budget tracker report. So when you create this budget tracker report, what it does is it says, here's the income that you have on the first, the deductions and taxes. So here's how much net income you have to work with. And then these are the things, the bills you have to pay on the first. And so I usually at home, I'll print this out. And then when I pay them, I have a binder and I'll just check a box here where it says paid, and I'll write in the dollar amount that I actually paid. And I always try to budget a little bit higher than what I'm expecting the expense to be because I'd rather have a surplus than a shortfall. But this is just a real handy report. The other thing I do, Joe, is I still, my wife and I, we pay a lot of stuff online, but we do cash envelope budgeting.
Yeah.
But instead of doing cash and envelopes, what we did is we set up a bunch of prepaid debit cards. So like I have a grocery prepaid debit card, I have a dining out prepaid debit card, I have spending cash debit card. And then instead of actually carrying physical cash, I just fill up each one of those debit cards. But this report tells me how much I need to put into each one of those buckets on the 1st and the 15th of every month. So that's how I use this personally. It's kind of a neat tool. People don't recognize that it's there. But so what you can see is it just helps you understand, helps you organize your expenses. And so some people, one of the things you want to do is take control of your spending in your, so that you're not having to manage this all the time. You're not having to wrangle with it. So the way I do it is on the 1st and the 15th, when we get paid, I just sit down and I make sure all of the bills get paid on the 1st and all the bills get paid on the 15th. And I transfer money into my prepaid debit cards. And by the way, I know you're a big fan of FAMZoo.
Yeah.
FAMZoo is, I found them to have the best deal for those prepaid debit cards in terms of the cost associated with them. So we use FAMZoo for the prepaid debit cards, even though I use the retirement budget calculator for organizing my expenses.
Oh, cool.
Yeah. And then there's some reports here. So you can see we've got a monthly expense report. So if you just want to see all of the expenses, one of the neat things is you can look and you can say, well, what are my expenses going to be in the year 2026? And so in this example, I've got the mortgage being paid off in 2026. So we see that expense going away in the future. And
I want to pause right there for a second, Jason, for everybody, because this is important. Obviously, if you're 30 years old and you're looking at when you're 60, you're not going to know month by month how expenses are going to change, but you do know this, that early in retirement, you're going to spend more money, mostly because you're more healthy, right? And then later on, you may spend less money on things like travel, but your health costs might go up, depending on what your health coverage is. So what I really like about this particular calculator is that you can specify those expenses and you can show lumps in your spending the way they happen. And so I know, Jason, you mentioned this earlier, but I definitely want to pause on this for just a second, because it is a big deal that maybe the first 6 months of retirement, you go on a big around the world trip, right? That's going to be a lot of money leaving your portfolio all at one time at the beginning of retirement. And being able to show that and what effect that has is much, much, much better than a calculator that just says, I'm going to live on $7,000 a month or whatever that number is. Being able to show the lumps is going to be part of how you win with your money.
Yeah. So to kind of underscore what you just were talking about there. So let's say you're just about to, let's say you're going to retire at 60 and you're going to have, $1,000 a month for healthcare until Medicare kicks in. So you could say, well, I'm going to pay $1,000 monthly and we're going to set that up on auto pay for health insurance. But we're going to say it goes up with inflation. And we're going to say that goes up at 6% per year, because that's the trend with medical expenses. They're going up at a higher rate. So you can assign a separate inflation factor to each expense, whereas maybe your auto insurance, you just want to assume like a 1% increase, or maybe 3% for most other expenses. And then you could stop this expense. So if you get to, say, you're 60 now, but you're going to say, well, in 2025, I'm not going to have that expense anymore. So then you can say, oh, it's going to end in January of 2025. So you can see the expense going away. And so there's just a lot of granularity. That the reason I built this was because I found that there were no other calculators out there that did what I wanted it to do. So Joe, you've got a couple different types of people on the show with us today. If there are people like me that are younger, say they're 40 or younger, really the only parts of the calculator they need are the budget data entry, assets, liability, time, quick view, and monthly details, and the net worth report. That's what's going to be most important to them, because it's just going to help them budget a little bit better and do it in a way that they're in control of it. And it incorporates both the ability to enter data in, not have to have your bank accounts linked up to it, and have a printed report that you're working from. So if you sit down, and I know you and your wife, you guys used to do those monthly meetings where you'd sit down and review kind of your budget and what the plan was for the month. It's nice to have something like that that's physical that you can print. Yeah. But for the people that are just getting ready to retire, that's where they're going to, they're 58, 59, 60, they're just getting ready to retire. That's where they're really going to want to understand the future view and the buckets tab.
Let's focus a little bit here then on the future view, but even before we do that, just to reiterate, so if I've got I can have expenses that end. So like my mortgage being paid off, let's say 3 or 4 years into retirement, maybe I finally have that paid off. Any debt that I might have, I can show that expense line item by line item, guys. You can show those going away, which will affect your cash flow. Also, you can show, let's say that that even though you're retired, you're going to do some consulting, right? More people, Jason, being involved in the gig economy. You could even show an income stream that happens for 5 years. Maybe the first 5 years you want a partial retirement, whatever that might be.
Yeah. Or so in this example, what I've done, Joe, is I said right now they've got this guy has $3,750 coming in on the 1st and $3,750 coming in on the 15th of every month. But that income's going to stop in 2021 because he's going to retire. And then right when he retires, so July of 2021, so down here, then we're going to start his Social Security in August of 2021. That's never going to end. And that income's going to go up at 1% per year adjusted for inflation. So maybe you have a gig economy, you're going to be an Uber driver and you're going to make an extra $1,000 a month. Or maybe you have a rental property that's generating $500 a month of net income. So you have the granularity to add this and make it unique to your specific situation, which again is really pretty cool. But let's go over to the future view tab. So a couple of things in this scenario. Number one, he's going to retire in 2021 and his Social Security is going to kick in. Number two, the way that we do taxes and deductions is you actually have to enter a dollar amount. So you'll notice right now we have him every pay period, he's withholding $450, about 12%, $900 is coming out for taxes. But you'll notice that ends in July of 2021. So I'll show you why that creates a problem in a second.
And Jason, I have to apologize to everybody. I just figured out how to have that on the screen.
Oh,
and have it be the full screen. So now everybody, I apologize. Apparently this thing's cooler than I thought it was. So, all right.
This is the mortgage getting paid off. So they have $1,600 principal and interest. It's going to end in 2025, but they still have taxes and insurance. So we got to keep, property taxes in there. They're going to pay that annually, and it's going to go up with inflation. And so we got to account for that. Of course, they've got food and personal care, insurance and medical. So I put some data in here just so they could see what's happening over time. But then we get out here to the future view tab, and you'll notice right now, I'm assuming just a simple growth rate on their liquid investable assets of 3% per year. And I'll show you some of the options you have there. But then you can see here's the year 2020, and he's 66, she's 63. And right now they have $90,000 a year of income. They have deductions and they have taxes. Their net income after deductions is taxes is $70,200. They're spending $89,000. So anytime there's a shortfall, that means we have to take the money out of this pot of money to make up the difference.
Yeah.
But there's also a growth rate. So the way we do the formula is we start with $1 million, we take out the 18,000, and then the remainder we multiply by 3% to give us the end of year value. Do you see that?
Yep.
Okay, now here he is, he retires in 2021. And so now in 2022, the only income that they have coming in is Social Security, that $2,000 a month that's going up with inflation. Now notice I don't have any taxes. I didn't put a dollar amount in for taxes. So this is not going to be accurate because they are going to have taxes. But you'll notice the amount of income they have is $24,240. They need $93,660. That means they have to pull out $69,000 out of this pot of money. So we pull this, we pull the $69,000 out, we multiply what's left by 3%, and at the end of that year, they have $99,115. You'll notice, though, their budget is high initially in retirement, but in the year 2025, I have them paying that mortgage off. So now you'll notice that the budget drops as a result of the mortgage getting paid off in 2025. Do you see how that works?
Yes.
So now the shortfall they have is less. So as we run down the page, you can see here's his life expectancy. The blue line is his life expectancy. So age 83, kind of give us an idea of how much money they may have left if he makes it to life expectancy. Here's her life expectancy at age 85. So if she dies at that point, there's 542. If they live all the way out to age 197, they've depleted all their money down to zero, their liquid investable assets all the way down to zero. So now we start to have some ideas. So one of the things we do is we allow you to, now I always tell people, assume very conservative returns. If you're assuming a 3% growth rate on your money, that's a pretty conservative assumption. But we do allow people
that's going to be, Jason, that's going to be 3%
simple.
After inflation, right? Is that after inflation? Because you've got inflation in here.
Yeah, we've already built inflation into the expense. Yeah. So it's a 3% return annually, but we've accounted for inflation on the expense side of things. So now in this scenario, we're saying, okay, what if we choose a 50% stock, 50% bond, and we show you over here what that model would look like. It assumes returns from 1978. That's the starting point, and then just projecting those forward and then repeating themselves every 40 years. Okay. So, and we rebalance the portfolio every year. So then we can say, okay, well, this would be like living 1978 again, 1979, 1980, assuming that 50-50 mix.
Yes.
This would be if we started retirement right at the time of the financial crisis, from the year starting in the year 2000 through 2018. So we capture both the dot-com bubble and the financial crisis during that period of time. So then you can see we've got some bad years in there. Then we've got the financial crisis. And again, this is using large cap stocks and treasury bonds only. So it's it's the index. So it's not going to really reflect how some of these investments would have performed, but it gives us some idea how asset allocation may have performed. Let's say they wanted to be more aggressive. And so they went more like 70% stock, 30% bonds, and then they have a bad sequence, a bad timing. So you can just kind of model some different return assumptions to understand how things would work. Again, I always like to say, hope for the best, plan for the worst. So if we're a simple growth and we're saying just a 3% growth rate, just to help people get an idea.
Well,
so the next thing happens. Oh, I'm sorry.
Yeah, actually, I want to pause there for just a couple things. We have a couple questions I want to address, Jason, and I also wanted to make a point here is that when I would meet with people, when I was a financial planner, one of the things that would happen is that people would come into the office and they want to talk about the stock market and what's going on today, or they'd want to talk about the election, or they want to talk about all these factors that we can't control. But what I really, really like about this calculator that I don't get with other ones, and this is why we wanted to partner with you, is I love those milestones at the end of the year that show where you should be with your assets. Because once we decide on the plan, so as Jason showed, guys, you can adjust and decide where you want the plan to be so that it works. And then that gives you a yearly number that you need to hit. So when I would meet face-to-face with my clients twice a year, we'd have 4 meetings, but 2 of them were on the phone or, technology. The other 2 were face-to-face. We did a face-to-face meeting. I would start off with that number, and we'd take all the resources and see are we ahead of that number or are we behind that number? And if we're behind that number, we didn't talk about the presidential election. We didn't talk about coronavirus. You know what we talked about? We talked about what were we going to do of all the things we have under our control. What were we going to do to try to get back to that number? And if we were ahead of the game, then we talked about what do we want to do with the surplus, right? Do we want to move up retirement? Do we want to spend more money this year? Do we want to save it for later? Do we want to build a bigger emergency fund? Like, all these things were actions that we could take, not the stuff that most people focus on, which is stuff that we don't have any control over. I got so excited there, I hit my microphone. But I think those are big. I want to address a couple of these before we get too far away, because we've been going for an hour and I'm not sure. Well, we've been going for 45 minutes. Wow. I'm not sure how long people can stay around, but Gregory asked this. He says, I think it's a great tool for DIYers, and my hunch is it's the majority of this community. For those of us who are less DIY, one thing I think is intimidating with respect to using a calculator is figuring out how to populate the data. He says, for instance, cost of college, cost of healthcare, those are really hard things to estimate. I'm curious, are you or the calculator provide any help figuring out what reasonable estimates are? I think here, Jason, this kind of thing is, you can play with different estimates, Gregory. You can say, well, let's say college costs, go to any publication, college costs going up by 7%. You can say, well, what if that slows down? How will we look? What if it speeds up? How will we look? But I think you can, the thing I like is that you can use whatever the accepted data is out there. And I think a simple Google search should give that to you.
Yeah, you're right. This is simple, but it's not easy. So, and the reason is because it does take some time and it does take some work on your part. I mean, you have to, and I would, instead of trying to figure out the future for Gregory, I would say, look, don't try to figure out the future cost of college. Try to figure out exactly what you're spending now. Just get really granular about some of these things that a lot of people, you ask them, how much are you spending for your cable, your internet, your garbage, your water, your sewer, gardening, yard maintenance? How much are you spending on restaurants, groceries, haircuts, dry cleaning, pet food, gym memberships? Because, I mean, let's start with the basics. Let's get those things really dialed in. And then you can start getting a little fancy going forward. Yeah. But the way that I did this, Joe, is I just sat down with my bank statements. I grabbed 3 months of bank statements. And I just started going through and I said, okay, where is all of our money going? And I would kind of average, 3 months. That's how I got started doing it. So I'd say, okay, we're spending $600 a month on groceries. I need to have a budget that says I need $600 a month. And so it takes a little bit of time doing it consistently to really start to make the numbers work. But then once you get a hang of it, then it's really pretty simple maintenance on a monthly basis. But there is some time required up front.
Sure. Then too, once you get those numbers in, then you can play, right? I think of it as play because I'm a nerd. Probably most people hanging out with us think of it as play. Matthew has a question here too, though. He says, aren't we pulling out more because IRA withdrawals are taxed? It's a good question, but Matthew, that definitely depends on where your money is. So the cool thing is that when you pull out from IRAs, you'll be able to show that tax. If it's a Roth, you're not going to show that same tax. So talk to that for a second, Jason.
It's such a good point, because remember, we're not doing tax calculations for you in the retirement budget calculator. You have to make an estimate because we don't know if this money is all IRA. We don't know if it's Roth. We don't know if it's non-qualified. I mean, we allow you to tag it as that, but we don't know how the distribution is going to work. And I didn't want to get into trying to build a calculator around the tax code, because it's changing all the time, and you've got state income taxes, and the tax code is so complicated. What I wanted to do was empower people to enter in the amount that they are projecting they're going to pay in taxes. And so you can see I've got an estimated tax rate here. So we're going to show you the estimated effective tax rate. So if this number looks too low or too high, then we know that we've got a problem. So for an example would be, these people are spending $91,380 a year. They've got $50,950 of income, but their estimated effective tax rate is only 6.45%. So all of this money better be coming out of a Roth or a non-qualified account to get this estimated tax rate that low, or this is designed to help us identify if the taxes that we're assuming, this dollar amount that we're assuming, is too high or too low. So we empower people to be able to know that, but we're not trying to do their taxes for them.
We have probably, Jason, I don't know how much time you have, but we could probably maybe another 5-10 minutes.
Let me show you the very last thing the calculator does, and then we'll do one more Q&A session.
Cool.
Okay. So once we know, in this example, right, 2022 is the year they're going to retire. So then we come over to the buckets tab, and in the buckets tab, we want to select the year 2022. That's going to be our first year of retirement. And so what the buckets tab is going to tell us is in 2022, 2023, and 2024, we're going to have a shortfall of 69,000, 71,000, 73,000. So a real popular idea in retirement cash flow is to say money that we need in the short term, we want to be relatively low risk, and money that we need that we know that we're not going to have to touch for 10 years, that's where we can afford to take more risk. So because the calculator is helping us understand how much our income is and how much our expenses are and what the shortfall is, how much we're going to have to be pulling out of our retirement accounts, it allows us to understand how much money we want to have in that cash position. So this is what I was talking about, Joe. If you use a bucket type of strategy and you've recently retired, and you know that you've got the first 3 years of cash, 214,000 in a money market account, and that's where you're going to be pulling your income from, and the market's falling off a cliff, but this next bucket was invested conservatively, this bucket was moderate, well, you're going to see the most volatility in this bucket here, but we know that we've got 3 years of time to recover from that market sell-off, and this is what gives people so much peace of mind. Now, there's plenty of people out there that can make an argument that bucketing reduces returns over time, and I don't disagree with that, but what it does is it helps with the emotional, psychological side of investing that says when the coronavirus hits and people are freaking out, we know that we've got enough cash on hand to weather a storm. And so I had Dr. Clunan from AAII. He is the founder of American Association of Individual Investors. I had him on the show after he launched his last book, Level 3 Investing. And we were talking about this idea of bucketing, and he liked the idea. And he said, historically, looking back at the market, that if you had somewhere between 3 to 5 years of cash on hand, that you were able to weather most of the financial storms out there. And then that's, now we're talking about diversified portfolios. And so again, this is just a real popular way. And because we know the spending, it helps us understand how to diversify our money in retirement, which is really a two-step process. First, you diversify the time horizon when you need it, and then you take the appropriate amount of risk based on how much time we have to work with. Does that make sense?
Well, not only does it make sense, it gets rid of one of the biggest problems that you and I see people make with their money when they get to retirement or close to retirement, Jason. On one hand, the people that are aggressive stay too aggressive with too much money, and then they can't weather a storm like we have now, to your point that you just said. But the other side's also true, which is you've seen people retire and they take every dollar and they make it conservative. and you're going to need some growth for those, for 30 years from now.
Well, I'm convinced part of the reason that happens is because of the way our industry is structured. So it's so easy to create a model portfolio and plug all of somebody's assets into just one model. It takes time to figure out how much should go into each segment, and then it's hard or harder to manage each segment separately. And so unfortunately, what most people end up with, even if they're working with a lot of times a really good advisor, it just takes so much more time and effort and energy on the advisor's part to create these different segments that a lot of people don't end up with a bucketing strategy. And it's not because it would not serve them well. It's just because it's not the most efficient way to run an investment firm. And so what I see is a lot of times people just end up with this basket of mutual funds. They really don't understand what it's designed for, what it's supposed to do, what rate of return they need to earn. People spend too much money in retirement, and most of the time when people get in trouble into retirement, it's not because their investments don't perform, it's because they spend too much. So I backed into this thing. I said, look, let's turn this thing on its head and make it about the most important thing. The reason you saved your money in the first place was to spend it and to have a good life and to be able to maintain your standard of living and spend the time that are most important with the most important people in your life. And so that's why the retirement budget calculator is focused on your spending. And unlike everything else in our industry, everything else is focused on rate of return, asset allocation, diversification, low cost index funds. That's all important stuff. But at the end of the day, nobody said, I'm planning for retirement so I can pay the lowest fee, or I'm planning for retirement so I can have the best ETF strategy. That's not what they were doing. What they were saying is, I want to be able to spend my money and live the rest of my life and have a good life. And so that's what we built the retirement budget calculator for, was for people that know that spending is what this whole thing is all about. And I walk life with real people. So I know that spending is the most important part.
It is, I love the reminder that it's just a fuel. I mean, the money really is just a fuel.
Yeah.
So especially at a time.
That's all I wanted to share. Let's do any additional questions and answers you have for us.
Yeah. If anybody has questions, we can be here for a little bit longer. And I apologize again about, for those of you that stumbled through later from YouTube. We had trouble getting YouTube up, and I still have no idea. We were on YouTube earlier today with Money with Friends, and it just didn't want to go this afternoon. So, of course, Eric says he's really enjoying playing with it. Thanks for all the hard work. He's amazed at the detail it contains. Yeah.
Thanks, man. Yeah. Appreciate it.
And you guys are, you and I started talking, or we talked about this a year ago, Jason, and between last year and this year, it's certainly changed a lot.
Oh, let me show you. I forgot to say one thing here, Joe. We, for your tribe, right now, let me double check something here. I don't want to sign up, and then
yeah, we got this as Stacker is the discount.
Yeah, we've got this discount code for your tribe. So you'll notice right now it's $7.95 a month when you sign up for it. But if you put in the all lowercase, make sure you do it all lowercase, Stacker, you'll notice that it changes to only $3.98 a month. So we're giving your community 50% off the cost. And that's lifetime. So as long as they keep the calculator, they're only going to pay that $3.98 a month. That's only good for the first 500 people that use your coupon code Stacker, but it's still active right now. So anybody that hasn't signed up yet, there's still.
Yeah, we had a bunch last week. I know when you were on the show talking about it.
Yeah.
And obviously I wanted to show people just why I like it today. So I'm glad you were able to do this. All right. Yeah. I'm not seeing any new questions right now. I think we covered it, Jason.
Awesome, man. Well, I appreciate the opportunity. Just want to encourage our community. There's one last thing I wanted to say about, if we're going to be given this opportunity to spend a little bit more time at home, at the end of the day, because I've been to a lot of celebrations of life and a lot of funerals, the thing that I'm reminded of is they always have some music that's playing at those services, and they always have pictures of people's lives. And so one of the things I've been thinking about is if we take ourselves to that moment in time, how do we really honor the people that are most important to us? How do we, if we're remembered for how we loved people, what does that look like? So during this downtime, really open up your photo app and start looking at all the pictures from the last year. Be reminded of how good life is. And then pick out one person that's really important in your life and just go through and make a photo book for them, using whatever app you want to use. And if you're going to get some time at home, it's just a really wonderful exercise to focus on the people you care about and realize how good life is, because you can't be grateful and worried at the same time. And so the way that we shift our thinking is to remind ourselves of how good life is, and be grateful for these moments and these people that we get to spend life with.
I wish you thought about that stuff a little bit. Well, thanks for hanging out with us, Jason. It's always good to see you, and congratulations on a job well done with the calculator. But Bo just reminded me, by the way, that we haven't had the I tried to have it up from time to time, but stackingbenjamins.com/calculator. There's only one calculator that we recommend, and this is the one. So good stuff. All right, guys, everybody have a fantastic weekend. You'll hear me back here on Monday with Stacking Benjamin show. And Jason, if people have questions directly for you when they go to the calculator site, is there a way to reach you right on there?
Yeah, there's a support email from the support page, from the FAQ page, so people can email if they have questions.
Awesome. All right, guys. Thanks a ton.
All right.
Talk to you soon. Go Stack some Benjamins, peeps. Bye-bye.
All right.